Yeah, welcome back to the lesson 4, which is chapter 4. We're going to look at the CIT, or corporate income tax. Corporate income tax, in few words, it is a tax. It is a tax charged on business profits of the companies. Therefore, from here we need to look at the declaration period. The declaration payment here. It is always 31st of March of the next tax period, and we need to see the tax period here. The tax period is always 1st of January of a certain of that current year to 31st December of the current year. So what happens here, the tax period may change, and where do you apply for the tax period changing? So when you want to change the tax period, you need to write, when you want to change the tax period here, you need to inform or to write to the Minicofin. Minicofin, it is Ministry of Finance and Economic Planning, and then copy to CG. CG is Commissioner General of RRA. So that is the time when you want to change your tax period in the business. We need to look at here the companies that are subject to CIT. Companies that are subject to CIT are subject to CIT. What are the companies that are subject to the CIT? Here we can talk of like what are the entities that are subject to CIT? We can talk of like companies, talk of like partnerships. We can talk of like associations. You can talk of de facto companies. You can talk of commercial public institution. Entities exempted to CIT, to corporate income tax. So number one entity, you can talk of city of Kigali, and districts, because they don't do the business. You can talk of like National Bank of Rwanda. You can talk of the entities that carries out activities of religious activities or humanitarian, or we can say the charitable organizations, the religions, so on and so forth. You can talk of the public institution in charge of social security, We can talk of RSSB, Rwanda Social Security Board. You can talk of BRD, Rwanda Development Bank. You can talk of BDF. BDF is Business Development Fund Limited, etc. Let us look at the exceptions. The exceptions on 30% of CIT. What are the exceptions? It's not always the case that the companies should pay 30% of corporate income taxes. There are some exceptions depending on different factors. Number one, however, the company lists the shares to the public through RIC, the CIT will have to change. The companies that have listed or have gone public have gone public through Rwanda Stock Exchange. They should pay different rates depending on the percentage shares they have listed through RIC, Rwanda Stock Exchange. For example, like 20%. 20% if a company has listed raised 40% of the stock. So the CIT of 20% is paid by the company that has listed 40% of the shares. So, and also the company can pay 25% of CIT if a company lists 30% of stock. And again, finally, the company can pay the CIT of 28% if a company lists 20% of its stock. However, these deductions are there for 5 years. Just there for 5 years after the companies gets back to 30%. Under the CIT, we need to look at what they call corporate restructuring. The corporate restructuring here, in other words, you can call it corporate reorganization. And what does it imply? It implies very many, it has different explanations. You can say, number one, the corporate restructuring can happen when two companies have merged together. I can say is a merger between companies. This can be the corporate structure. Another thing, one company can acquire. One company acquires 50% of shares of another company. Another company. I think you can say one company acquires 50% of assets and liabilities of another company. So number four can be again, one company can take over another company. Can take over another company. Another point can also be a resident company. Resident company can split into two, can be splitted into two or more companies. So all these means the corporate structuring, and there are very many others you can look for. You can look for more. Let us look at the tax implications here of the corporate restructuring. So number one implication is the transferring company. The transferring company here is exempted from the capital gains and losses. Is exempted from the capital gains and losses. So the second exemption can also be the acquiring company. The acquiring company should record the assets. Should record the assets. The assets at their book value. At their book value, and as at the acquisition date. As at the acquisition date. Another implication can be the acquiring company. The acquiring company can also continue to depreciate. To depreciate the assets. The assets as per the policies. As per the policies of acquiree. As per the policies of acquiree. Liquidation, how the liquidation proceeds are treated as per the tax structure here. So the proceeds, the liquidation proceeds are taxed the same way dividends are taxed the same way the dividends are taxed. So let's look at the format. So for the format, we just say the proceeds from sale of assets. Just post your figure here. You raise liabilities. That liabilities, maybe the short-term or long-term liabilities you are obliged to pay, like maybe paying the suppliers or paying the employees. So you less liabilities, and again you less the share capital. You less the share capital, and you also post it here. Then you get liquidation proceeds. You get your liquidation proceeds, and then after you apply your tax. And as I've said that these liquidation proceeds are taxed the same way the dividends are taxed. That means that it is 15%. Then you put the tax liability right here. This short question: the company X was liquidated 31st December 2018, and proceeds were 250 million Rwandan francs. The liabilities were 100 million Rwandan francs, and the capital were 20 million Rwandan francs. Then required to compute the liquidation. Of course, as I've said, that you need to come up with proceeds from sale of assets, and the proceeds we have here is 250 millions. Erase the liabilities. The liabilities, which is 100 million. 100 million, and then erase the share capital, which was 20 million, and here you get 250 minus 100, that remains 150. 150 minus 20, that gives me 130 million as liquidation proceeds. So, and then you apply the tax of 15% times 130 million. Here the tax is 15% times 130 million, which gives me 19.5 million. We need to do the question I've given you in the questions I sent you for the revision and on my YouTube account, and the solution is right here. We are going to work on it, where it is a computation of taxable income and tax liabilities of Made in Rwanda Limited for the year ended 31st December 2016. So here we have particulars, we have workings here, we have Rwandan francs, and it is in all figures are in thousands, are in millions. So that's why I've hung up the 3 zeros. Number one, we need to come up with operating, because that statement had the operating profit. So you need to come up with operating profit here, which is 14,200. So that means that this is 14,200,000. So you add non-allowable expense, non-allowable expense. So the non-allowable expense here we have, number one is it is maintenance. We have we add non-allowable expense. Under non-allowable expense we have repair and maintenance, R&M, which is 8,000. that is 8 million, of course, because zeros are hung, 3 zeros are hung. We have bad debts, and bad debts, the accountant showed, or in the statement it is showed that it is 4.2 million, but the specific one is 2.5 million. So under working here, you get 4.2 minus 2, 500. So this gives me 1,700. That is 1.7 million. So I also have the office furniture. It is also non-arable deductions. Office furnitures here is 10 million. 10 million. I have the communication, the non-arable, because the company couldn't be able to divide, couldn't be able to separate the communication that was used for private use, or the communication that was used for the business use. So therefore, we regard 20% as for the private business and the 80% as for the business. Therefore, we need to calculate 20%, to look at 20% of 8 million. So this gives us 1.6. So, and we have dividends as an honorable expense, which is 25 millions. 25 millions. So therefore, the total is 46 millions. 46 millions and 800. So therefore, we need to check. The total here, which is 61 millions. So let's less allowable expense. We raise allowable expense not recorded. Allowable expense not recorded. Allowable expense not recorded. We have accrued salaries. The accrued salaries here, we have 4.7 millions. So we also raise non-arable incomes. Non-arable incomes here, which is non-arable incomes, which is dividend from local company. The dividend from a local company, from the local company, which is 10 million. And then we get the total. Which is 45 million. So this is the taxable amount. So the taxable amount or taxable income. So we need to charge the CIT. We need to charge the tax. CIT is 30% of taxable income, which is 45 million. Taxable income, which is 45 million. 800, and this gives me the CIT of 30% of 45 million, which is the taxable income. So this gives me 13 million and 740,000. So that is the end of the question. Loss, the computation of loss. Loss is also computed the same way the profit is computed. But when the business realizes the loss, it has to be carried forward into next tax periods until the loss is recovered, and then the company starts to pay the tax. Like if the computation of taxable profit results into ROS. So the ROS should be carried forward. The ROS should be carried forward. The ROS should be carried forward for a period of 5 years. For a period of 5 years to offset the future. To offset the losses in future. So therefore, we can have an example here. The question that I have also sent you, it is also in my YouTube description account, and I've sent it also to your emails. So let us look at the solution of it. First of all, the year, we have the years here. We have 2006, we have 2007, and we have 2008. And these are the 3 years. So the P&L here, the P&L was showing that in 2006 we made a loss of 500,000. So in 2007, this Dusaimana is a businessman, made the profit of 200, and in 2008 he made the profit of 1 million. So therefore, we have to compute the taxable profits. So here you need to say that ROS relief. The ROS relief here, you need to bring 500 here, which will give you the taxable profit. The 500 here, it gives 0 because this is negative, this is positive, it gives you 0. And when you take this 500 that has been that is here, it should be carried forward to the next year as a ROS, and it cannot be offset all of it. So you need to take 200 here. So you also get 0. And if 200 has been able to be offset because we made a profit here, so that means that we are remaining with 300 loss that has not yet been recovered. So therefore, you take this one minus this one. 1 million has been able to cover the 300,000 as a loss, so the remaining is 700. So 700. So the company finally made a profit in 2008 because of the losses that has been carried forward from 2006 up to 2008. So that is the time it made a profit. So therefore, this one is subject to the CIT of 30%. Let us stop from here our chapter as the CIT from the loss carried forward. The rest you can read it, you can just revise it. It is the special incentives for registered investors in Rwanda. So those ones, that is theory, you can read it and you come up with the summary. So thank you so much.